Guys. Okay, it's Markets with May, and tonight I'm going to be talking about the home builders. And it's interesting because I feel like I've gotten so reactive in all of my videos. And one of my friends was like, May, we're fundamental people. We don't react to the markets like this. What are you doing? Sorry, let me just move over a little bit. He's like, you got to get back to being a fundamental person because you're so reactive to all the events that are happening out there. You forget that when markets are falling, they create opportunities. So tonight with the home builders, I'm going to go through three of the largest out there. There's manufacturing housing and there's other stuff as well. But we're really going to go through Pulte, Lennar, and we're going to go through DR Horton. And I'm going to go through the ones I like the best, or the one I like kind of the good, the bad, the ugly. Let's call it that. Actually, but they're all really kind of good. And that's the crazy thing is that the financials look unbelievable. So all you really need is for interest rates to come down or to plateau and not increase any further. Now, I think that this is not something that's going to happen right away. So I wanted to go ahead and do this video because, a lot of people that are looking to invest also have time on the weekends to really do due diligence. And so I really encourage that if this video ends up being interesting to you, such that you want to learn about this space, then you should absolutely 100% go and do due diligence wherever it makes sense to do due diligence. Quite frankly, these three home builders do have locations in anything from like 20 something to 30 plus states in the United States. So go look at these homes. Really quickly, though, past performance, not indicative of future returns. I actually will admit that I do have positions definitely in Pulte, which is going to be my favorite of the group. And then I may also have some residual stuff in Lennar. And I don't think I have anything in DR Horton at this time. But in fairness, there's a little bit of we'll go through it. I'll show you. Okay, so the reason that the home builders are interesting no matter what isn't just because of rates. It's really because of this. And from time to time, people try to pretend like this isn't true. They're wrong, okay? This comes from the St. Louis Fed, and we have a significant underbuild period. And that is because what happened in 2008 scared the bejesus out of every building contractor across the nation, quite frankly. And we didn't really start to see the increase, the meaningful increase in housing starts until 2018. So a lot of times you'll get these young analysts, they'll come out and they'll try to pretend like home sales are off the charts higher, but they don't realize that like we are coming off as such a dramatic decline in housing starts. And that's what people actually mean when they say the US is lacking in housing inventory. Now, if you're just trying to like listen to that and make sense of it relative to everything you're hearing, the other place you can see this is in CPI. A big component of CPI is actually what they call rental expense, but they also do an adjustment for any house and mortgage price to keep that in there as well. The fact that the last month alone, you saw a huge uptick in rental prices is a testament that this chart is no lie, and that the folks that are trying to present it otherwise, they need to increase the duration of their chart. They need to go back a ways because they're really not showing it properly. Because there's such low housing stock, what's happened is rents are increasing. It's just pure supply and demand. But because interest rates are where they are right now, there's the housing starts numbers that have come out economically in the last few months have been dismal. People are just not building houses. Now, I want to show you these three home builders. These are the three majors. There's a lot of smaller builders, okay? And I will ultimately and eventually, because I got more than one person that has asked me, here, let me get this out of the way so it's not in the way. Hold on. There's a lot of folks that just aren't doing, that are all right, I won't be able to take it off. I'll just have to deal with it. All right, so there's a lot of folks out there. They used to be builders. There's a lot of smaller builders out there that may also be very interesting, and I will get to the public ones in time. There's also manufactured housing, but these guys are doing proper homes, fairly large homes, that sort of thing. And like I said, you should visit them. In order of what I like is DR Horton, Lennar, and Pulte. But in fairness, if rates change any meaningful amount of way, DR Horton is going to flip on a dime. Probably you might get a little bit of more leverage. Now, I want you to kind of see this, and I always hate it because this thing gives me certain you can kind of see that the enterprise value to EBITDA is what you really want to look at when it comes to home builders. And I'm going to tell you why. It's really straightforward. Okay. It's still a house. And if you think about your own taxes, you get a lot of depreciation, a lot of, and then also there's all those costs that you're writing off, right? But also enterprise value includes the debt that's on their books. And what you see when you look at forward PE and you compare it to enterprise value is you see that the EV to EBITDA number is lower, which can only mean either their cash to debt situation has gotten better, or alternatively, their depreciation is helping them. Now, depreciation is going to be more or less the same no matter what. So it really is the fact that these guys shored up immediately before any kind of potential issue. And they've been doing that, by the way, since last year. These guys, they're in it to win it for the long game. These guys have been around for a while. So they didn't wait to start like taking it down a notch. As soon as interest rates started to increase, they were like, no, we're done with this house, but we're going to sell out the inventory and call it what it is. Now, the other big thing that people oftentimes when they're talking about the home builders that they are just missing in every possible entire way that is like, I don't even know how to tell you how bad they're missing it, is that they just don't realize that what happened was last year you had raw material costs increase like crazy. And then quite frankly, steel prices, lumber prices, all kinds of pricing dropped. And you can see that whether you go to the charts for the different pieces, types of raw material. Also, a big component of every house is actually plastic, PVC piping. Because oil has dropped so precipitously, even the price of PVC piping, et cetera, is down. So you actually have this situation where a lot of the sales that came out last year for a 6-month build, the pre-sale, is now getting priced through, and you're getting these really incredible earnings reports. Okay. With that, let me go through them, and you'll see that I'll go through DR Horton first, which I like ever so slightly the least from a stock perspective. Again, like I said, if this economy picks back up, if certain things pick back up, you're going to see all of them swing up. So, all right, let me share my screen again. All right, DR Horton. Here's DR Horton, 2% up, but their costs went up, and operating net income down 15%. This is the worst of the three. And the reason for this is DR Horton, for those of you that have been in the housing market before looking at different home builders that are on new homes, DR Horton has a tendency to allow you just a little bit more customization than the other two. Okay. And so for that reason, for across the homes that they were selling, there were a few more concessions that they gave to try to sell out their inventory. And there are a few more things they did. So DR Horton probably looks the ugliest out of the financials, but this is not the end all be all. They're still making pretty good numbers. And that's why, we're still talking about something that's 5 times EBITDA, EV to EBITDA, which means that in 5 years, if this is the low, and we stayed there for 5 years, you would see them basically turning it through and paying you back in 5 years' time, making every dollar that you invested in it. Now, here's the operating. When you look at these, you really have to go through the entire financials. Here, you can see very clearly in the cash flow statement, there's a decrease in construction in progress. So the cash flow is positive from that. And the reason it's positive is because basically they're not applying capital anymore to construction. And what they are doing is increasing rental properties, which you can kind of see. So there's more money going into improving the rental property situation. And this is the strategy they took. They bought more land. Okay. That was their strategy as we move forward, going forward. And you can see it clear as day on the operating income line. Additionally, let me get to the balance sheet. Oh, I put these in the wrong order. Sorry, on the balance sheet, you'll see something very similar. And then the other thing I want to just show you regionally, they are much more exposed to the Southeast. And that really is Florida, Atlanta. You have a lot of folks that are moving to Florida. What you would do to help with your due diligence and research is you should look at population growth in those Southeast states, but also Southwest. You're going to see a lot more activity there as well. And you can kind of see it straight through in the numbers. Now, I, for whatever reason, don't have 2 of the slides that I thought I had in here, but you will see that there was slightly more pricing that DR Horton took. So they did lower pricing just a touch. That's why they're only up 2%. Okay, Lennar. Sorry, let me go to Lennar next because I think that that's probably the right call. Lennar significantly better. Lennar and Pulte significantly better. And what they did, Lennar is going to be a great new home. And for a lot of folks that have big ambitions, Lennar is like a really fancy starter home. Let me say it that way, but still fancy nonetheless, because it is a brand spanking new home. And some people do definitely do this as their everyday home, but this is going to be more of the subdivisions that have more, I don't want to say cookie cutter because it's still a new home and it's certainly very expensive purchase, but that's Lennar's deal. You guys should definitely go visit and see, because it's pretty easy to understand the deal there. But because of the nature of it, they actually benefited from that dynamic I told you about, where raw material costs came down, and so they could get those pre-sales done with lower material costs. And that's why you have EPS going up 21%. Operating earnings was down a touch as well. So it's kind of that you can see is coming. So yeah, that's coming from, so basically they got slightly better on cost of goods sold. They sold slightly less units. And because of the mix of what happened, as well as some land sales they did, you end up with earnings much higher. That's Lennar's story in a nutshell. But let's look through it regardless. You've got, here you can see the sales of land change it up a bit. You can see cost. So they basically sold out land, but they just really got rid of it. There wasn't a lot of excess revenue that happened from that. And the reason is because your revenue was 9, but your cost of goods sold was much higher. So they're just clearing it out to liquidate for cash, and so on and so forth. If you look at the geographic mix, you can see that the only geography that kind of maintained pricing, so to speak, was the East, which really, I'm going to tell you, is the southern states. It's not the Northeast, because we don't have that kind of dynamic going on right now. So otherwise, they went ahead and took pricing, and that's why the cost of goods sold looks the way it did. And then they just liquidated what they could. So that's what's happening with Lennar. And then you can also see here, their inventories were up slightly. Land was up slightly, but realize that you've got some things going on in there. So like they sold some pieces of some parcels that were no good. They bought better parcels with the cash they had. That's kind of what you're seeing there. And then the most important thing that you want to look for across all of these when you're going through balance sheet is what's happening to financial services. Financial services within a home builder is them doing some kind of financing for you, either for your customization, so you're not necessarily getting your mortgage on your customization, or they're facilitating a little bit of the sale itself by giving you a little bit of a break, because you might have a timing gap between when your finance is going through whatever. But financial services, you really need to see that. Not be increasing during a market where rates are going up and we've got this financial situation crisis happening right now. And so basically that actually looks okay here, as you can see, more or less. The financial services business is down significantly. So they're able to get rid of those mortgages, and that's really important. And you're going to want to watch that. And like I said, you got some time on this to do your own personal research and figure out if the home builders are right. And also you can do your own personal thought process on what it looks like is going to happen to interest rates. Now, the one I actually like, wait, look, let me keep going through this. Total liabilities, you still got a lot of cash. You do have, you have $4 billion in cash, okay, so let me just show you. You have $4 billion in cash over here. You don't have that much liabilities against it. It's not hyper leveraged, and that's what we're seeing across the big cap home builders, and that's really important. It just tells you how much they're shoring up the balance sheet. And again, you can kind of see their whole strategy was keep the cash there, and then decrease inventory like crazy, sell those homes, or alternatively rent them out. Okay, either one. And if you're probably like, well, hey, with rates like this, who's buying homes? It turns out, because of the shortage that we were talking about earlier on, because of this chart up here, and also because when you look across the types of homes that are being built, multifamily was actually trying to fill this gap for people that needed housing at a reasonable price on the rental side. But because there hasn't been since last year a lot of multifamily build, instead, some of the new homes that these builders are just trying to get way off balance sheet. Those are getting purchased by investors and then being rented out. So that's what's actually happening for the big builders. They are definitely not trying to build a ton of houses right now. They are definitely trying to get rid of inventory. And if anything, when you look at inventory, they're separating out the land component of inventory, which they're not building on, versus actual houses, just letting them flow right on through. Okay. And then the last one that I'm just going to go through, and you can see almost clearly why I'm a little bit biased towards Pulte, especially if we do a decrease. And hopefully you guys can see my ridiculously tiny font here. So sorry about that. But you can see it's really, if you look at Pulte, revenue growth was crazy high, 17%. EPS was up 47%. And that was a clean number that was done off of just selling homes. And they came in a little bit faster to like take in inventory and not try to oversell. And again, because they're kind of, I want to say they're definitely still a bit more customizable than a Lennar type of home, but also so they're kind of in the sweet spot. There's enough standardization and not quite so much customization that they had to give concessions. So they did get a little bit more benefit than Pulte on the fact that raw material costs came through and they were able to order in a savvy way. So that's what's happening here as to why they did well. But quite frankly, all of them are really smart. All of them were like, ooh, I don't like this rising interest rate scenario that's happening here. Plus, I don't like what raw material costs are doing. So if we're going to pre-sell homes, we're not going to build them until these raw material costs come down. And then, all of them actually hire some of the absolute best economists on staff. I'm trying to ignore some of the love that you guys are giving me on these chats. Y'all are pretty funny, but yeah. So Pulte is a little bit looking better off the quarter. I was actually shocked when they came in this high, but nonetheless, I'm not crazy surprised because all of these guys have been behaving as if they learned major lessons in 2008 that they weren't going to repeat. Here we can kind of see house and land inventory. This is really land inventory. And then really what they've done and they're clear about is they're selling out the land that they don't necessarily want. And they're happy to just get rid of it. And they're buying the land in parcels in places where they think there's going to be some new build. And if you think about it, there's a lot of places where we know there's going to be some build because we are bringing some stuff on shore, particularly in the tech sector. So especially if you live in one of those areas, have yourself a look and definitely go take a look, see how it's selling, and then observe it until you start to see with rates doing what they're doing, a good time to maybe invest in these. Okay, so liabilities you can see are pretty low. For a home builder, this is fairly low leverage. Total liabilities at 5.8 billion and then cash of $1 billion, with most of it being housing and land inventory, some of which is just things that are now houses that they're just literally going to deliver over the course of the next 3 to 6 months, however long it takes to deliver the house. Okay. Other stuff from Pulte. This one, okay, loss on debt retirement, nothing because they're not doing badly here. What did I want to highlight? Because none of this is really worthy of highlighting. Oh yeah, you can see as well down here on inventories. Yeah, this is really good. So this is the cash flow from operations. So you almost have to flip the sign. So they have a lot less. So basically inventories, they do have a bit more going on in inventories, but they're not holding any of this crazy mortgage stuff like they did in 2008. This is a much healthier situation than 2008, but you do see a little bit of inventory build there coming through as the houses work their way out of Pulte to the actual person that bought it. And then we look at cash flow from financing. You can see that the major change in financing this quarter is really the share repurchases. And again, not any problems on the debt side whatsoever. And net financing is actually a lower use of cash than it was before. And that's kind of really it. Yeah, that's really it for this episode. I wanted to just put it on your radar screen because I don't want all my videos to be reactive to something that happened. And that's pretty it. I love that you guys are all saying hello to each other. Let me just give some shout outs. Thank you guys for supporting my channel. Novocaine, you crack me up. I love that. Grandpa Barney, thank you for supporting me. Appreciate the kudos for all the haters that I get. I appreciate that. Yes, I'll give you a couple comments. Look, right now, I'm hoping that some of the gamesmanship is coming out, especially with the announcements on Citadel. So I'm excited for that too. I would say someone did ask me a question about why are people buying puts on ape, and I will remind people that because there's no options on ape, the only way to hedge out your ape if you have a very large side of it would be to buy puts or sell calls on AMC. Selling calls on AMC is really scary because AMC is really volatile, but buying puts to protect your ape position, people do it. I do not do it because I have the position small enough where I don't have to hedge it and waste that kind of capital, because I think those puts are not going to happen, quite frankly. But people that got a lot bigger size than ape might be doing it. So I did want to mention that because that's been asked on some of my comments. It's not the most straightforward thing to write in the comments, even though I tried to. Let's see what we got. Oh, and then we just got, let me see. Savvy, thank you for stopping by. James Harris. Dude, I hope you're doing well. Long time no see. Kevin W. Let's see. I'm in Canada. Okay, listen, I don't know about Canada, but you should probably the Canadian organizations also look at that. Now, one of the things with Canada is because you got a lot of immigration coming in, you have some of that empty housing from foreign investors that came in and bought. So that one you kind of have to look at. But if you're looking in the US, technically there is a housing shortage, even though it's very regional, and sometimes people get a little bit distorted, because if you look at a chart from 2008 to current, it looks like we built a lot. But if you dial that back and realize that this is over a decade shortage that we tried to start to correct from 2008 to 2019, you'll see it more clearly what and why there's still a healthy investment market in the housing market. But with rates where they're at right now, it's really more investors, so wealthy people that aren't necessarily needing to borrow anything to buy those houses. And as a result, they're taking advantage where they can. But great question, Kevin. And then this is really only the US. You would have to do approximately the same research if you're looking locally, and you really want to look at the balance sheet and make sure there's no funny business going on there and that the company's under levered, because we do have some craziness going on. So good question. If for regional, yeah, that's great. That's true. In a lot of places, you have not seen any kind of decline in home building prices. And I believe my understanding with Seattle from some of the real estate investment trusts that have reported is not only has it not dropped, but rental prices have actually started to improve dramatically, especially among your higher quality houses. Now, there aren't that many REITs that do more for the middle class and for the more distressed folks that are looking to try to find housing. So that is something to know. So yeah, it's going to be market by market, but definitely all of those home builders do build homes in Seattle. So you have some time, because I think there's still a lot of uncertainty whether rates are going up or down. What I would anticipate across all of this is that you won't see things go a particular way until, so what will happen is you might still see rates rise, but what you really need is for people to either have rates stabilize, not even go down, and for there to be a little bit more clarity on the fact that we're not going to just crush GDP in every possible way. Because right now there's like this massive crushing action that's happening. Also, the banks will have to be a little bit more stable, because even though the home builders do offer to a higher quality group of people, if these debt markets continue to seize up too aggressively, even the home builders with really great balance sheets are not going to be able to show revenue growth or earnings growth. So this is one where you do your research now and you just be ready when it starts to look like it's going to turn. You may have as much as one full more quarter to this, but if we start loosening up money and if we start any kind of quantitative easing, if the banks, it becomes clear that the Fed is going to take on more than they should as these banks do what they do, because housing is such a mess right now, and we really do need more supply to help out everything from lower income, middle income folks. That's where we would see it. Okay. Awesome, Grandpa Barney. You got a great rate. Amazing, amazing, amazing. We'll end it there. Thank you guys for your support. Hopefully that's helpful. And